So welcome all to this webinar on volatile markets, and suddenly one can see based on interactions with various people that they are in two minds: should I be buying or should I be selling? Okay, because there's a lot of news that one is getting and saying, yeah, something crazy is going to happen. We're going to see recession. Nasdaq has really fallen. Okay, and there are various points there. Uh, so this is something which I thought is a good thing to have based on some of my interactions with people. Okay, before I start, I thought let's start off on a lighter vein. And there was this terminology called kangaroo markets, and that's where, if you see, this particular slide also has kangaroos out there. So any ideas what's a kangaroo market? Yeah, either you can unmute and speak, or you can push it on the chat. Okay, somebody said sideways. No. Okay, so bumpy ride. Yeah, that's, I think, jumping. Yes. Okay, so it basically is about the way they define it. It moves up and down. It's a bumpy ride. Okay, and without any rhyme or reason. Okay, so sometime back you would have said, oh, COVID, things are going to go down, fall very sharply, and then suddenly market goes up. And then when everything looks good, economy looks good, the market goes down. Okay, and when you thought that, okay, the Ukraine war started, there was a lot of volatility before it, but immediately after, actually, there was not much. And of course, the impact sort of came a little later. So that's one term that you can take home. And I must actually thank my team for bringing that to my notice as well. Okay. So this is what and where the markets have been. Okay, so just to set context, interestingly, Nifty has fallen lesser, and it's even fallen lesser than the S&P 500. While you see the Nasdaq has a very, very steep fall, and for a lot of us from the technology industry, and there was a lot of positive news flow, and we thought that post COVID, digital can only enhance and get larger and larger, but you found that Nasdaq actually, and the biggest of the biggies, falling very sharply out there. And for some of us who have ESOPs, unfortunately, we may have seen deep cuts. And maybe that's one thing that one can also take towards the end as to what maybe one can do on some of the ESOPs, because there are at times difficult decisions to take. Okay, but within Indian markets, we have seen that mid caps and small caps have done very well. So mid caps is sort of almost like the Nifty 50 itself, but small caps have really fallen very, very sharply. And what is sort of the prime reason for this? Okay, the prime reason for this is markets got spooked by increasing interest rates, and so possibly the trigger point, okay, was the Russia-Ukraine war. Okay, wherein a lot of commodities that come out of Ukraine, and those got disrupted, which sort of only accentuated and increased the inflation and the prices there. And what is very interesting in all of this is, I mean, I don't remember the last time I saw the inflation in USA higher than India, and not a small number either, because if you saw inflation of 3% or 4% in the US, you would say, oh, crazy inflation. Okay, but today it's sort of more than double that number, and this table is a little dated, maybe a couple of weeks, and I thought, and one saw a slightly higher inflation number also in the more recent announcement that came in the US as well. Okay, so this is what sort of impacted, and one of the key reasons for the US doing well and is their monetary policy, wherein they kept interest rates very low, and now suddenly higher interest rates are really worrying markets quite a bit. And today, even if I think the US government wants to and the Fed wants to keep interest rate low, they have no option, because actually the common man is getting impacted by inflation. So if they have to counter inflation, they have to increase interest rates. So for economies like the US, it's between a decision between the devil and the deep blue sea, and that's the difficult part. For India, we saw some bit of stuff around. Sorry. The outflows that we saw, and some crazy numbers too. FI outflows were something like between October and June, okay, is 3.6 lakh crores have been taken out. Okay, what is interesting is even though 3.6 lakh crores is taken out, the Nifty return is not as bad. If you look at it from that perspective, it's 12.39% down. Okay, and you may wonder why is it lower than the previous number I showed. The previous number was the fall from the high. Here we are talking about the returns between October and June. There are two dates there because we wanted to show that the impact of the FI flows in this particular period. Okay, and in that the same time, maybe one of the reasons why it's not as large a fall, because you saw that say in May of 2008 to Feb 2009, if you saw that there's a large outflow, and that saw something like a 43% negative return. Okay, so yeah, so that is something. Nayak, you had some question. I think you raised a hand. Okay, so then I'll come back, okay, and maybe take questions later for the benefit of all. So if you don't mind, yeah, and so part of it is because the inflows from domestic DII. Now DII is domestic institutional investors. Okay, so what that basically means is all the mutual funds, all the insurance companies, all of it are termed as DIIs. So effectively, it is retail money, coming in from Indian investors. Okay, so that is something that, and all of us know that there has been a large inflow that has sort of come in, in this period of time. Yeah. So before we move forward, I just wanted to, take a poll from all of you and ask you, where do you think the Sensex will be 3 years from now? Okay. Is it going to be 75,000? Do you think it's going to go? 75,000 is significantly up from here. Is it going to be is going to go down, or is it going to remain flat? I'll request Sanjay to just kickstart the poll. And right now, just for perspective, it's something like 51,360. Okay. Okay, we have, interestingly, we have a lot of bullish people on this group. Almost 58 of us, have said we think 75. Okay, I'll give you just maybe a few seconds, and then I'll end the poll. Okay. Yeah, I think everybody's answered. So, we have almost like 78% saying 75,000 of the index. It's interesting. Okay, I wanted to write a higher number. Okay. But I said, okay, let's start off with 75,000 or more. Okay, and we have about 10% feel that it will go down, and another 11% feel that it will remain flat. So thank you for okay. I'm also sharing the results for your benefit. Yeah. Thank you. So what are so that in context, and all of us are reasonably bullish. That's, I think, interesting one, because when I'm going and talking to outsiders, many of whom are not our customers as well, has been a lot of concern saying that, do you think we'll go into recession? Do you think that it's a longer term impact? And some have come back and told me that some of their friends were saying that, they think that this time the downturn will be sort of much longer. So that's an interesting one. And let me tell you what is sort of my concern out here. Okay, so my concern out here is actually coming out from the Nasdaq. Okay, and one has had a very negative view on the US markets as well as especially Nasdaq. And a lot of people came and asked me why you feel Nasdaq should come down, because I told them that I cannot see any logical reason right now. The only thing is, it's in bubble territory and it's gone up too much. Okay, and when it happens like that, you will find the reasons sort of come out later. And who expected it, to be triggered by the Ukraine war, right? So you cannot even imagine what sort of and where it starts from and comes from. Okay, so the red sort of line is a moving average, which is called the exponential moving average, is a 200-day moving, 200-week moving average actually, which basically you're looking at the weekly closes for 200 weeks, and we are plotting it on a moving basis for the previous 200 weeks. Okay, and that's how this is there. And the only period that the Nasdaq came below this was in 2001. Okay, so even at COVID time, if you see it bounced off the 200-week moving average. Okay, so this time it's just broken down below. Now it's if you look at technical analysis, it's too early to say that it will break down, but our concern is will this happen? So this is 2000. Okay, and the fall that happened after the 2000 boom that we saw. We had the Y2K boom, so that was also digital led at that point of time. Okay, and what is interesting, if you see in a relatively short period of time, which means from 97 to 2000 or so, the market went up from the Nasdaq went up from 800 points to almost 4,800 points. Okay, almost like 5x. Okay, so that has been the thing. And so if I look at here the 200-week moving average, it broke, it went below, it came up above, and which is something that actually I would expect in some form to happen. There should be intermediate rallies as well, and the fall then comes down, and if it breaks the moving average, unfortunately, then there's a larger move on the downside as well. So while we've seen a 34%, it may not end at 34%, unfortunately. And a sector turn like this, typically the sector which is leading, when it turns, it loses anywhere between 60 to 70%. So that is something which is worrying us. And when that happens, and when the volatility happens, you also end up seeing Indian markets and other markets also see volatility, linked to that. And markets have their own way, and some of us may think that why is it fallen, etc. When we start looking at some of the numbers, you'll see that markets have their own way of being reasonably rational. If you let away the noise that comes in from various people and the media and your friends, etc. The numbers numbers reflect into what one sees. Now, what is our learning from the Fed interest rate hikes? Okay, so what is interesting in all of this, the light brown graph is how the Nifty moved, right? And what it says is it impacts by higher volatility, but in most cases it has been an upward sloping curve. Okay, so it's not been a really crazy impact because of Fed interest rates hikes, but over a period of time, especially when it starts hurting, you'll find that the volatility also increases significantly. So that is something that we sort of keep in mind, that all is not over because Fed is increasing interest rates, but yes, there's a bit of heightened volatility there. And the point is, if you look at it from the long term, and this is the chart of the Sensex. If you look at it from the long term, all the falls look very, very small, especially if it's much earlier, right? So we saw one of the largest fall of 60% was in 2008. So you can see this period there was a reasonably large fall that happened. Okay, and so if you come back and see, there was another large fall in 2001. Okay, but because markets have really gone up so much, right? It actually looks a very small impact out there. So all of these falls will look a blip over the longer term and period if you look at it. Okay, so in reality, so what is it that our viewers and what is it that we think from a long-term basis, because that is what should drive what we are doing. Okay, because our viewers always, there's lots of money to be made in markets in the long term. In the short term, things may confuse you a bit, and and they may be those only temporary. So it's not, let's say, lasting if you do not take some emotional decisions at that point of time. So long-term macro view is that yes, India, when will it become a $5 trillion economy? I think it's not a question of will it. I think it's only a question of when. Okay, and there are a lot of things which are sort of going for India, right from if you look at the first one, I would capture is the demographic dividend, which basically means that our median age of the population is about 28 right now. Okay, and what does that mean when your median age is very low? Okay, it means a lot of people who are not yet in the working age. So you'll have people at the 60s plus, you'll have people who are at the 15 to 20, 25, 21, etc., who not yet sort of come into the working age. So now there's a large set of people who will actually now start coming into the working age, and this is what happened in the US. Okay, in 1980, and it was called the baby boomers bull run that triggered by the baby boomers, because after the World War, you had people came back and there were a lot of children, okay, that they had, and so there was a baby boomer period that happened, and the median age for the US in 1970 was something like 28, and 1980 was 30, and from 1980 onwards, when it hit 30, one saw a huge market rally for the next over 20 years. In fact, if you look at even the current market, looks like part of that baby boomers rally in itself. Okay, so that's the type of large and the index itself moved up almost, like, if I remember right, 6 times or so in a 20-year period. So that is something that those can happen while there's domestic consumption created by the new set of people who are starting out. There's a lot of infrastructure investments that are happening, roads, rail, etc., and the capital outlay is something like $1.5 trillion. And so if some of it comes in, it's proven, like if you saw many of the countries like China, etc., when infrastructure is in place, growth also automatically comes in. There are a couple of other ones which are interesting, like India emerging as a manufacturing hub as well. Earlier services drove a lot of the exports. One believes that manufacturing will drive, and we're already seeing that. In fact, some of our buys in our portfolios, like specialty chemicals, etc., were on the manufacturing side, and there was a good move towards India. There's this whole concept of MNCs wanting to do an India plus, a China plus one strategy, okay, which basically means that they want to de-risk themselves from their supply chain issues and move some bit of their manufacturing to other countries apart from China. And India will be one of the key beneficiaries from this. It has also come in at a time when the Modi government has brought in a lot of benefits for exports. They have come in with the performance-linked incentive schemes for, say, electronics, etc., which again we have another company in that space, and they are all likely to do very, very well. The whole startup ecosystem, the digital adoption that you see in India is another big one. Okay, because it makes our economy, much more efficient by digitizing it. So today the UPI, system is one of the most robust. What's interesting, Google, uses the UPI system, and they were smart enough to use the UPI system, while some of the other Indian companies try to do their own. Okay, and it's a very robust and a very low cost thing there. You will find that in some cases, we are ahead of some of the other countries on the digital side, and the whole ecosystem that has come up from the startup side is another one, which one thinks that that itself will drive some bit of growth. And last of all, I would like to say that it's lower interest rates. Now, not too many other countries like the US, there's this joke that said they have to increase interest rates so that tomorrow, when the economy hurts, they have to decrease it again. Okay, so we don't have that much of a problem here because our interest rates are already fallen well. So even if we have to increase interest rates, we don't have to go back to, we won't even have to go back to earlier levels of 9%, FD equivalents and stuff like that. So I think that lower interest rate is one of the biggest drivers for the economy because it creates efficiency, even directly, indirectly. For directly it can be through lower interest costs for companies. Indirectly, it could even be through infrastructure, because let us say an infrastructure project takes 5 years or 3 years to complete. Sometimes you look at the metro, etc. It's much longer in Bangalore. Okay, so you can imagine that the borrowing that has come about it, right? And if interest rates were say 12%, which it was earlier, or now it is say 6-7%, possibly for a good quality borrower, okay, or even an 8% for somebody who's okay, right? So there's a huge savings that it comes in on a capital expenditure and the also the efficiency that it brings into the whole ecosystem indirectly. But I think the whole point is what drives Indian markets, okay, and or in fact any other stock market. What drives it is only earnings, okay, and last decade was not a great decade for India, and you can see that that's this chart also shows why, because in that period from FY10 to say FY20, the growth was very muted. It was unlike the past. So you saw that similar period of 97 to 2003, right? If you see the right chart, okay, so the growth in earnings was something like, the growth in profits was almost flattish. Then there was a spike that happened between 2003 and 2008 that coincided with a huge bull run, okay, and then sort of it plateaued to 2010. So but 2011 to 2020, growth was there, but it was a very muted growth, okay. So which is where our indices also didn't do very well in the last decade. But you can see already in the current decade, the earnings are spiking and expected to spike up even more, okay. So and if I look at it as a percentage, which is the left chart, which says corporate profits to GDP ratio, okay, it had been coming down all the way from 2008 to 2020, okay, but now the expectation is that that percentage to GDP is only going to go up. So it's a very good thing for India in the medium term. And this is just a chart to show how the two lines, if you look at it, the brown line is a 5-period moving average of Nifty, and the green line is the 5-period moving average of EPS growth. Okay, so you'll find that they sort of go in line. Okay, and while in particular years they may diverge, but broadly they sort of go in a similar direction. So how do we manage volatility? And we've heard, okay, what about the index? Okay, what's going to happen? It's probably going to come down. We're going to see some volatility. We'll also talk about how much do we think we can see volatility as we come forward. What is the level that we are thinking for the index on the lower side? Okay, but the question, how do you manage it, right? So, and that's what helps you take decisions. A simple thing, and this is about diversification, right? So what this does is it looks at returns year by year, okay, and a very simple table saying that gold returns in FY21 was say -4%, and in the same period the bond returns were 4%. The Sensex gave 22, and the mid caps and small caps gave almost like 63%. And so just a year by year chart of how the returns were. Okay, so what it really shows out is in almost like every year, of course, bond funds typically don't go negative. Okay, so you don't have a red there. Okay, but you'll find that there are periods when it's very low at 4%, like in the last year. Okay, and at the same time, the periods when interest rates are high, you'll probably find the index doesn't do as well. Okay, of course, there are periods when both of them do well together. Okay, but normally you'll find that when interest rates are very high, the markets also are a little muted, and those could be periods also when sometimes the markets also fall when interest rates are high. Okay, so the point here is you look at assets in a complementary way and you diversify. Okay, that's the simple one-liner that I would say. And there are different periods where suddenly you'll find gold runs up like the stock market, and like in 2009 and 2010 when it gave 25 and 29%. And so in a period where 2007 also it gave something like 32%. So it's good to have a combination of assets and bonds, large cap, mid cap, etc. What we try to do is we try to maybe look at the cycles a little more closely and move between them. Even within bonds, if you look at short term, you look at long term, etc. Okay, but in summary, I think it's important to be diversified, have a good asset allocation across, based on what is your risk profile. Okay, so the other part of it is about, I think, is emotional. It has nothing to do with markets. Okay, so I would say if you are able to overcome fear, hope, and greed, okay, you will definitely make money in markets. Okay, and unfortunately, markets tempt you to do the opposite thing. Okay, and let me give you an example also. In recent times, right, crypto was, a lot of questions we got around crypto. Okay, and I know some clients also came to us and say, almost pleading with us, say, allow me to do some crypto in my portfolio. Okay, so of course, what one told them is, we think that crypto is also an overheated market, and we think in the long term, crypto may do okay. We are concerned about two things. We are concerned about the legality of it, and we are also concerned about the second one, that it actually works counter to governments. Okay, so if crypto does very well in the longer term, it will say impact the US dollar, and governments are the one which make policies, right? So unfortunately, the power is there in the government side, and they can make certain policies which suddenly create a lot of disturbance to a particular asset class. So that sort of, in the long term also, we were little not so comfortable with it. And of course, our view also, we don't understand crypto, so we didn't want to sort of invest into it. But one told customers, if there's some money you want to just gamble around and keep it maybe even less than 1% of your portfolio, okay, that's something that you can do. And typically, like any other asset as well, when markets are down and when crypto is down, it's a better time to do, rather than do it when you hear everybody making money, right? So that's something that all of us sort of need to keep in mind if you're able to overcome. Because and I'm giving this example because suddenly at least two people came back and said, now shall I sell it? Okay, so while I'm not a crypto fan, I think it's down the dumps, just leave it and sleep over it, and possibly it'll do well. Of course, the only issue that one has is one hopes that it is not an asset that continues. There's some cryptos which actually went bust, right? So some of the organization went bust, and so one just hopes that if you're not in a situation where that particular thing doesn't it's not there anymore, right? But if the crypto is able to sort of be around, then you'll probably it'll reverse and make money again. But this is not a, it's definitely not a suggestion to people to go and buy into crypto. Right? And this, I mean, I wrote my book, Honey, I Lost All Our Money. One of the key reasons was this particular instance of one of our customers where he was a 50 or plus, and he had large losses of almost like 3 crores on his portfolio. What happened is one day he used to work with us, and he had some bit of stuff around mutual funds and stocks with us, and he used to do something on his own because he had then retired, and so he said, okay, I have free time. He started doing futures and options. Okay, at times he used to come to me saying, why do you hold cash on your portfolios? And my point to him is that sometimes cash is king. Cash can be one of the best performing asset classes by not losing money. Right. So, and it gives me the currency tomorrow to go back and buy it at a lower rate if one has the opportunity to do so. So he came to me one day and said, Anil, I need some 1 crore of rupees. Okay. He sounded very, very tense. I said, okay. And this is, luckily we had done some profit booking. So I said, okay, this is how much is anyway there in the debt side, which we had to profit to invest later. Okay. But, these are the 3-4 things, places where, because we don't have 1 crore in debt right now, we may have to take out of some of the equity, and this will be the impact. And we went ahead doing it. Okay, and when I spoke to him later, he told me the story. Right, so he started investing, and he made money. Right, FNOs, then he put a little more money, and that he made even more money. Right, and then unfortunately for him, 2008 came. He missed the turning point of the market. And if you're looking at futures and options, you need to keep in mind that you can, especially futures, you can lose more than your capital. Okay, so in this case, he had made some great returns. He lost all of it, and he went negative on a cumulative basis. Okay, by 3 crores. Okay, so of course he had also exited some of the other assets of his, some FDs, etc., that he had to cough it up. And but this is a point that I'm making for all of us, that if we are able to overcome fear and greed and hope, right? So then we should be able to do well, and that's one reason why we don't use futures and options unless we do it for hedging. Okay, and the reason for it is, you cannot just sleep over it. Okay, you cannot say, okay, you know what, okay, I missed this fall. Okay, so let me just not look at my portfolio for another 6 to 12 months. Okay, so that benefit you don't have. So that's something that one just wants to highlight. And at times like this, the emotion is very important. And I can tell you, markets will tempt you to do the opposite. All the news will be exactly opposite of what it should be, especially at the real crisis times. And that's one thing that I've trained myself to do. So like even on the COVID fall, for example, when I saw 2 market level freezes, I said whatever money that was there for customers, okay, and we had taken money out of and we had taken cash calls in our portfolios as well. We went and put all of it on 23rd of March 2020. Okay, so that was this exact low, and the low actually got hit when there was complete crisis, and people said they didn't know where it would go. There was uncertainty. Like I said, the market froze twice. Right? So, and of course, we look at it from as professionals, we do our own study and numbers, and for me, numbers actually help me take a logical decision and not get carried away by markets. Okay, so you'll have to excuse me for the charts and all the numbers that sort of come with my presentations. Okay, because that's how I do it. And one is basically you have the Fed model, okay, which basically looks at earnings yield by the GSEC yield. Okay, and so you'll find that, and that's the light brown graph that you see. Okay, line And so the line graph, you will find that interestingly, when sort of it comes down, the Nifty also, comes down, and then from there it sort of takes a bit of a jump, as soon as it comes and hits the lower points of somewhere around 65%. Okay, so that is something that we are already there on a forward multiple basis. Okay, and we'll probably see some, so the good news is there's not too much of time left for this volatility, and yeah, so at max, I think at least this chart shows that we should be done by, say, March, April. The other is, while I spoke of cycles, and this one shows it. Okay, we just look at the differential return between large cap and mid cap. Okay, very simple way of looking at it. And again, that when you look at it on a graph, it's very interesting. Okay, that the market swing between mid caps and large caps. Okay, so you could find a period where mid caps did 85% better than large caps. Okay, so that in relative terms, both equity, but you could find it does that much better. Of course, that was a very extreme reading that we saw in something like 2016. Okay, but you will also find that it could be 35% worse than large caps. Okay, so and the bad news is that probably at that time the large caps may be down, and you find this maybe 35% even lower. So it may really be difficult for you to manage that volatility at that point of time. Okay, so that's something that we look at, and if I look at this graph, okay, the mid caps, for example, have not yet touched the green line. Okay, the horizontal line. Okay, so that is something that we felt that there was some bit of steam left. Of course, on these small caps, it had crossed. And again, if you remember, I told you that markets have a very logical way of doing things, right? And this is why probably the small cap index fell much more. Okay, so that is something that we sort of keep in mind. Okay, so there are many questions that we may have, right? And these are some of them. How much more will central banks increase interest rates? Will markets fall further? Will the global economy get into a recession? When will inflation peak? When will Ukraine war end? Because there are many questions like that. But again, unfortunately, I'll go back to numbers. Okay, and what is real is also that is the Nifty Pe Ratio. Okay, has come down to, actually it fell below 20 in this volatility. Okay, and it's interesting that even while the markets were going, the dark brown graph, okay, actually is the Nifty. Okay, and you will see that between 20 and 21 or so, you found that that was a very sharp upward moving curve. But even during that period, okay, you found that from 21 onwards, there was a very sharp fall in the PE ratio. And so what is the PE ratio? PE ratio is the simplest maybe valuation ratio that we have, okay, which basically says what is the price by earnings. Okay, and let me just give you an example. So if the earnings per share, okay, of a company is say 10 rupees, the share price, if it is 250, it means that the P ratio is 25. If the share price for the same 10 rupee earning per share company is 15 times, then the price will be 150. Okay, so you're basically saying that for the same earnings, I'm able to equate across industries, across cycles, across time periods, and say, yes, what is the Nifty like? So if Nifty is high, the P is higher, that means markets are more risky. If P is lower, markets are less risky. So the last time we saw P at 20 was only in COVID. Okay, before that, the previous time we saw is in 2016. So what one is saying is we've come to valuation levels which are like almost 6-year lows. Okay, so that is the thing there. And so I'm also not trying to answer how far, if the fall happens, how far do we think it can fall? And which is the table on the right hand side of the graph. Okay, we've just captured the year, we've captured maximum drawdowns. Drawdowns is basically how much the market fell from the peak. Okay, from the highest value, how much the lowest, the fall immediately from that. Okay, so in 2001, for example, the market fell 51%. The P ratio before the fall was 28. Okay, similarly, if I looked at in 2008, when the fall was 60%, the P ratio was 28. Okay, so when the P ratio is high, right, is where the falls are larger. So similarly, 2020, when it was, the drawdown was say 38%, okay, the P ratio before the fall was 29. Similarly, if I see there have been falls from market lows, okay, when P was 21 and 22. Okay, so in 2004, for example, it fell 30%. Okay, a 30% fall on a P of 22 effectively will bring the P down to around 16, 17. Okay, so if you see all of these cases, wherever the P ratio, and market fell, right? Even in 2007, it fell only 15%, but P ratio was 20, which means it came down to 17. Okay, so that's something that we think is a bit of the floor. Yes, markets overdo on both sides, so you may see 15, but those will typically be temporary, and it's always good to leave aside. You cannot time the last 10% or 15%. So we believe we're already closer to that level. Okay, and we should look to deploy money, and our views, it'll do very, very well as we go forward. Okay, and the better way of doing it is, to do it on market falls, and we still think that time wise, it's about 3 to 6 months is what we believe the volatility hopefully will end in that sort of period. Because also when you look at market falls, typically the fall has taken on an average between 9 months to something like 18 months. And the largest fall, interestingly, in 2008 that we saw was between January and October, right? So in just about 9 months, it fell 60%. Okay, so that is something that one sort of keeps in mind. That so time wise also we already have spent some bit of time, because from November onwards or so, markets have been down. We already spent some time down. Okay, and we think that we probably hopefully be done by something September to December of this year. And the second way of looking at it is to say, and which is even today we are already less than 22, right? So if I look at a P ratio range less than 22, okay, 3 years from there, the index has given an absolute return of 62% plus on an average. Okay, and of course that's an absolute return, so which means an annual return of almost like 20% or so, if you on a simple basis. Okay, so similarly, if it was about 22, interestingly, the returns have been 16 to 18%. Okay, and which effectively is almost like only a debt-like return, which means 6%. Okay, for over 3 years, you get that 5 to 6% because you're 16 to 18%, right? So that is something that we think that if we go by historical data and all the numbers, I think we're coming back to saying, luckily we are sort of closer to the end, but we still think there's volatility likely to be there, up to say about 15%, on the downside, and you should take advantage of markets while they are there, because if those are few opportunities that you get, and if you're there, you make good return from there. So just to summarize, we're saying that already spoke of this short-term volatility. Long term, we think that markets will do reasonably well. We believe that India will be the star of this decade. Okay, and so that should be good. Market valuations as per us are comfortable around 20 levels, and further fall will only make Indian markets more attractive, and we won't be surprised at those times to see FIs come in as large numbers on the upside. Okay, so today, if you see why are FIs selling? Interestingly, they're not selling India. They're selling emerging economies, and India today has become a good, almost like a 20% in emerging markets. If I see, one of the most famous MSCI index, which is from Morgan Stanley. Okay, so India has a good weightage right now. So if investors in developed markets say, let me take money out of emerging markets, India will get a hit from that as a percentage. Okay, so how do you manage volatility? I spoke of behavior. Markets tempt you to do the opposite. Okay, let your financial plan drive your investments, your goals, your needs. Okay, they may be far away. I mean, don't honestly get bothered too much by short-term movements. Yes, first, professionals, that's our job to look at it short-term as well and try to do whatever best we can. Profit booking and other things is something that one can look at when markets are doing well. I sent out a note that we are not going very aggressive this time because market valuations are much more comfortable than in past periods when we do aggressive profit bookings. Asset allocation is prime. It's the best way to get superior returns. Long-term disciplined investing, diversify your portfolio, all these very, very basic boring things that if you do, you'll probably do very well. And manage risk on portfolios, do systematic investments. Okay, so that's about, I think I'm not spending too much time on these because these are aspects that, we've kept repeating, and one can see that, your portfolios as well, that, the growth has been reasonably good. Okay, and if you have the ability, okay, market volatility can be a great friend. Okay, it can be a great friend to enhance your returns. Okay, so that's something that I've always been a contrarian, and it has worked very well for me. Okay, and just a quick one on asset classes because there were some questions as well. Okay, we think that I spent enough time on equity markets. Debt side, yes, interest rates are going up and likely to go up. Now you may look at your debt funds and say, oh, I got 4% or so, what's happening. Okay. Actually, interestingly, when, the yields have gone up today, we look at the yield to maturity of what are the holdings of bonds. Okay. And some of them have gone all the way up to 7% right now. So the good news is your debt funds will start giving you better returns as you go forward. Okay. There could be, again, we don't suggest longer term bonds because there could be volatility because of interest rates going up. Okay, but floating rate funds are a good way to go about it in the current environment. Okay, and gold, we think that sometime gold will one more phase of fly like a rocket, and possibly when we see the US under pressure, you may see gold do sort of better. Real estate, with lower interest rates from the past, hopefully, that should also, on the longer term, do better. Right now, there's a lot of past inventory and all of it, which sort of needs to be consumed before we start. Okay, so I think that's all from my side. Okay, so feel free to sort of reach out to myself or the team, and we'll be happy to support you. We'll get off straight away into the questions. Sanjay, can you?
Yes, sir. Yes, I will.
Quickly.
Yeah. So the first question is that, is recession imminent? If so, what should be our strategy?
Yeah. So so if I look by definitions, for example, in the US, you may see recession actually set in. Okay, and so that is something which can come in. In India, even if you see it, I think you'll probably see it for a short period of time. So honestly, I'm not as concerned about recession right now. In fact, those are periods when then government comes back and takes certain measures, and that typically is where confidence has come back. So if I go back to 2008, when there was the largest fall that happened, one would have found that markets fell, and then government stepped in around October of even earlier, possibly of 2008, and markets sort of turned around in a quick V-shaped recovery. The faster the fall, the good news is the faster the recovery typically is. Okay, if it's slow and long, then then it may take slow and long to go on the upside as well.
Thank you, sir. The next question is that how to foresee the downtrend or turning point of market?
See, what I normally do is I look at multiple things, and sometimes, and I'll give you the example that I spoke of the US and NASDAQ. Maybe I've been saying this for the last 3 years. Okay, it's very difficult to time the exact point. Okay, but one thing was very clear, even within my team, and I saw because customers were coming back to them and saying, you know what, my friend did, this NASDAQ fund and they did very well. Okay, so customers are coming and giving pressure saying that, why don't you invest in ABCD things? Okay, the team also at times, came back and said, yeah, this is a better performing fund. And so whenever I saw some of it, one said, let's take it off the list and, move away from some of these funds. Okay, and so, but how do you look at it? One is just look at, is it looking, overvalued? If it, I look at numbers, I look at technical charts, I look at the interplay between asset classes, because sometimes gold will give you the message. Okay, gold will suddenly run up and you'll find that, okay, the smarter investors already being conservative. Interest rates going up, coming down, all of those are interplays that sort of one looks at it. So I think you need to look at a whole lot of parameters to be able to try and identify the turning point. But the fact is, you can never time it perfectly well. Okay, so you should not even try to time it perfectly well. Yes, but there are some people who are very good technical chartists. I myself follow a few of them. Okay, because for me, some of it gives me the first warning bells, or it triggers the first opportunity from a turning point. So those are things that one can also do. But broadly, it's not a very easy thing. And especially on the selling side, right? The buying side, you may get it easy, right? But selling side is, I can tell you, a lot more difficult.
Thank you, sir. The next question is that how is the real estate market going to be?
Yeah, so I think it will slowly stabilize and come back. Okay, but right now there's so much of volatility running around, so that again, interest rates going up a little bit is going to be negative to the sector. Okay, so I would not be in a hurry to buy real estate right now. I think maybe in the longer term, if what I'm saying is likely to happen, and India is going to be the star of this decade, then real estate also will move up. Okay, but what happens is also India, as we get more developed as an economy, like in the US. I mean, a lot of Indians are buying real estate in the US, unfortunately. So but if you look at there, people reduce the percentage of fixed assets to your financial assets. Okay, so and I think as India goes to from a 2 trillion, 3 trillion, 5 trillion economy, you'll probably see that financial assets will play a larger role. So you shouldn't be in a great hurry to buy your real estate, and I would rather say take some money out of the markets and go and buy my house, if that's something that one wanted. Yeah.
Yeah, thank you, sir. The next question is that do you mean that further falls are predicted based on PE ratio?
Sorry?
Sir, the question is, do you mean that further falls are predicted based on PE ratio? So,
yeah, based on PE ratio, see, it doesn't predict a fall, but it says it sort of we try to look at a floor from it. Okay, so, and the floor is somewhere around 16 of the PE.
Thank you, sir. So the next question is that how many days the volatility will continue as per your research?
Like I mentioned, I think 3 to 6 months.
Yeah, thank you, sir. The next question is that should we buy now more equity or not?
Always, but keep some money for later. Okay, so even at this time, phased exit. So even I'll give an example also on our PMS, which we do a little differently, and today I oversee that directly myself. Okay, and so what we did is when we saw market suddenly get volatile around March, people who had even given money at that time, we deployed it on a very slow basis compared to the past. Okay, and we just kept deploying on each of the larger falls. So portfolios were protected a little better than the index in itself. Okay, so similarly, I'm saying that even going forward, we still think it's a time to phase in money. If sort of you give money to the PMS to us, that we automatically do it, unless it's a smaller sum, that it's just a small top up, then we do it one shot. But otherwise, if it's a larger sum, versus what you hold in your portfolio. We typically phase it in so that we manage risk for you. And there, otherwise, if you're doing a mutual funds, then I think a systematic transfer can be a good option. Again, I would do somewhere like 4 months or so.
Thank you, sir. The next question is buying gold now is good hedge?
Yeah, gold is always a good hedge to equity markets. Okay, and one can sort of we like to do that also in a systematic basis. Okay, so we played the cycle of gold, including on flexi cap, which gave us flexibility as a flexi cap portfolio to also buy gold ETFs. We bought it when it was really low at a key point, and we sold it off as well. It would have given 50 to 60% returns in that period. So you could have periods where gold can also do very well. So now we felt it was a bit of a sideways move, so we didn't come back and participate in it. Okay, so I think we should just do a phased manner right now, because there's nothing which really pushing us to sort of buy gold. Okay, but clearly one believes that the returns will be higher over the next 3 to 5 years compared to the past.
Thank you, sir. The next question is it good to buy index or specific stocks during this volatility? For example, good IT stocks fell more than 50%.
Yeah, so unfortunately, IT is closer to NASDAQ. Okay, so and sometimes they may not be connected, because see, the stocks which are crazily overvalued are ones like the digital guys and all the big names that you have. All of them are at some reasonable valuations. Okay, so they're the ones which may fall more. But unfortunately, how markets do is they say, oh, IT, tech. They don't look at the difference between, especially when they're selling, right? So you'll find let's say investors in the US saying that just let me just take out all my tech in India as well. And so that is something that one could see and happen. So one would see a slightly higher volatility on the tech side because of it. The second point that is more fundamental, okay, because you must keep in mind markets have a way to predict the future. Okay, and you'll first find markets would have fallen, then you'll know why, and why it would have gone up, and later on you may realize why it's gone up. Okay, so markets have phenomenal predictive ability and to do it in advance. So one of the things that I am also a little cautious about IT is my prediction of the US, right? And for IT in India, mostly IT services companies, right? And if I'm doing that category of IT services companies, okay, if the US as a market is struggling and companies are struggling there, then you will find technology in India also will be significantly impacted, because from what I've seen, anywhere between say typically more than 50% of most of the IT services companies have revenues coming in from the US. Okay, so I'd be a little cautious on IT and not just go gung-ho on IT right now.
Okay, so next question is that when you say real estate will do well in long term, you mean over 3 to 5 years or 7 years plus?
Yes, so I'm saying maybe 5 to 7 years. Okay, 5 to 10 years. Okay, so I'm not suggesting 3 to 5 years. Because real estate normally has a lag with equities. Okay, so in fact, I did this for one of my property. It was around 2008. The market fell. Okay, and we wanted to let go of this old office of ours. Okay, which was a residential place to invest in something else. Okay, and so because we had also shifted our office out of there into a commercial place. Okay, and then as soon as I saw markets falling, I accelerated my sale. Okay, and it was good because then I could have, if I wanted, I could have bought it at a lower price later.
Thank you, sir. The next question is that why cement sector is down as whole, and in China context, what is the future about metal sector in general and non-fuel in particular?
Yeah. The cement sector basically, yeah, this is I think going stock level and sector level. Okay, I think as a whole, right, construction and all all of these, did well for some time and sort of have come back right now and fallen sharply. Some of it can be to, they went higher on the upside for some time. So, they are corrections and they're natural corrections. Okay, but one can see on the ground as well that, their growth, etc., sort of like a little bit muted. Some of it also includes, some bit of acquisitions that have happened, new capacities have come in. Okay, so cement also sort of got impacted from, some of that. Okay, so one thinks that it will be volatile in the short term, but long term sort of maybe come back as the economy sort of does better. Metals, it's been our view that commodities are going to again do very well in this decade. Okay, at a global level, not just in India. Okay, because metals, you should look at global markets and global prices rather than Indian prices, because they will follow suit. Okay, so so metals we are bullish on. At the same time, metals are very volatile sectors. For example, we held it in various portfolios of ours. We normally don't touch metals till we are really bullish for a long term. Okay, but in the recent volatility when Nasdaq broke down, okay, we looked back at our portfolio and said, which is the highest risk sector that we have. So we reduced, either we reduced by more than half or we exited metals fully in one particular portfolio. Okay, so that is that. But I mean, I'll still be watching to possibly get back into metals at some point of time. Okay, so so bullish in the long term. Okay, but it's a very high volatile sector, and while we are managing public money and we are reporting it on a month-to-month basis, and we need to sort of show consistency in returns to clients. Okay, we don't have the luxury of being able to ride through it and just leave it in the portfolio, which I may have done it, for myself as an individual. Okay, but I think even for you, I think as an investor as a whole, possibly the levels are much more attractive than the past. So if you want to look at again, do a bit of a phased investment in the metal sector can be profitable for you.
Yeah, thank you, sir. The next question is that can we do some profit booking of investment of 5 years?
If we believe 3 years is going to be much higher, so why would you do profit booking in a very large way? Okay, that's an approach that one took. Also because valuations are not very high, but we did come out. We looked at portfolios which are say above 60% of equity. Clients were at above 60% of equity and above certain threshold. Then we said yes. We kept target index level based profit booking is what we looked at doing for our clients. So that is something which is an approach that we took. Okay, but I also sent out a note before that saying this time we are not going to be as aggressive. Okay, so in our profit bookings, and which is why the percentage also that we did was much smaller. But we just said, okay, I have to manage risk, and where the very large equity, then it may make sense just to take something out so that I have money to put in case markets go down further.
Thank you, sir. The next question is that which index fund is good to buy, Nifty, mid cap, or small cap?
So at this point of time, because I think Nifty and small cap means small cap and mid cap have done very well already, I would go back to looking at the Nifty. But this is always a question that people have: should I buy index or should I buy non-index managed schemes and stuff? So in India, I think data still shows that managed funds deliver better than the index. Okay, so that is something that and I think it will continue to do for some time. India is not yet as mature in stock market as, let's say, the US yet. Okay, so you'll probably see a very high differential of fund returns versus the index. So it makes sense to continue to do that, and that's always net of cost, because both of the ETF as well as your equity mutual fund, both of them have expenses as part of it. So we'll take just maybe a question, Sanjay, and we'll try to maybe answer the rest of your questions. Because just to respect the time that we have and all of us have sort of put in here. Thank you.
Thank you, sir. Thank you, everyone. Thank you for joining in. We will be sending the recordings and feedback from. You can also mention if you want us to cover any specific topic, and we will be doing next webinar on wealth creation option for NRI. So looking forward to seeing you all there. Thank you, everyone. Thank you.
Thank you all, and appreciate you spending your time on a Saturday morning. And I hope you took a few points away, and wishing you all the best.